In this week's update, already stretched commodity markets set to get tighter. Good equities being trashed along with the rest, but that equals opportunity. And why the odds are that this remains a cyclical bear market. My name's Garry Davis. As always, this is general advice, and please remember to like and subscribe to the video. Let's start with some market perspective. It's been an incredibly eventful week, obviously disastrous week in many ways. We've had the invasion of Ukraine by Russia. That caused the oil price to spike. But despite that, bond yields on Thursday fell quite sharply. Now, whether that was partly the thought that this will delay the Fed raising interest rates, or whether it was a bit of a flight to safety and people were buying bonds prices going up means yields go down. It's perhaps a mixture of the two, but the net result was, with bond yields falling and with growth stocks having been sold off so heavily and really just looking for a trigger to turn around, then that was it. The fact that bond yields dropped from over 2 to about 1.8. And so that initiated a spectacular reversal on Thursday night where growth stocks rallied. The market futures were down enormously. I think the Dow was down nearly 1,000 points just before the open, and so the market opened up sharply lower, but then just turned around and absolutely sizzled to the upside. So quite an extraordinary turnaround. But I guess the obvious question is, well, where do we go from here? Now, as we'll see as we work through the charts, brief multi-day rallies are just a normal part of cyclical bear markets. So the fact that we've had one of the strongest intraday reversals in history, and the US market indices ended up actually positive last week, is not an automatic conclusion that the cyclical bear market is over. Now, that is possible because there are a range of scenarios to do with Ukraine, from best case to worst case. If best case were to play out, which is Russia abruptly withdraws, and I think the odds of that happening appear to be almost nil, then we could have seen the end of this selling. But that eventuality is incredibly unlikely, and it's more likely that we're going to get something more towards the extreme end, in which case the cyclical bear market will continue. But short covering rallies always happen. They're just part of human nature. They're unavoidable. Stocks get sold off so far that the only way that people who are short the market can realise a profit is they have to start buying to lock that profit in. And so it's just part of the process of greed. They've been short, they've amassed an enormous amount of profit. They want to tuck that profit away before somebody else takes it off them. And so there is a short covering rally. So they always happen, but they do not signal in themselves the end of that bear market phase. So that's the important point that I want to make. Now, if you've got strategic cash, which I've been advocating, started talking about it in mid-December and have been advocating it strongly since early January. If you've got strategic cash, then this period is good news from a market perspective. I mean, it's obviously not good news for Ukrainians and for the rest of Europe, but putting that aside, just looking at it purely through a financial lens, which is what this video is about, then it's actually good news for investors, because as prices of stocks, good stocks, fall, the long-term returns gets sharply higher. So as an example, let's say you've got a stock, and because of its earnings growth and a sensible long-term PE multiple, the price is going to work its way towards, say, $20. If the stock is currently at $10, then you're looking at doubling your money over the long term. But if you can buy that stock for $5, then you can quadruple your return. So the way to look at this is not to be fearful about prices falling and think, what is wrong with the stock, or how much further is it going to fall? You know, all those sort of emotions that come into play. The way to think about this is that, you know, you're able to buy a $10 stock for $5, and it's going to end up at $20 at some point in the future anyway. So you need to look at this as an opportunity, not as something to wring your hands about. The second point I want to make is that if you go defensive now, you've copped a fair bit of selling pressure, I'm sure, in the last 2 months. So you've had the pain, and if you now go defensive, it's going to be very difficult to get back in early enough to participate in the gain, because that's just how psychology is. Once you've moved to a defensive position and are more comfortable with that, then you don't want to jump back into the fire too soon. And so it's almost impossible to get back in somewhere near the lows. You want to see proof. And proof comes from the market going up for many weeks or many months. And by then you've missed it. So the net result of turning defensive now will be to have experienced the pain and miss out on the gain, which to me is just dumb. The preferred action was that you cashed up, as I've been talking about now for about 6 weeks. You cashed up to a level that provided you with some firepower to exploit this opportunity, which is where we are at the moment. American stocks, the S&P, because of that massive rebound on Thursday and a bit of follow through on Friday, ended up gaining 0.8% for the week, whereas it was looking a real disaster at one stage. Thursday's reversal was absolutely monumental. I thought Friday, not so much at the index level, it didn't look too bad, but when you look at a couple of hundred US stocks, Friday was not all that impressive in my view. So that is why I'm not really changing my position, that I think there's more to play out in this cyclical bear market. The situation with Ukraine is adding an extra dimension of uncertainty to the market and volatility to the market. But the bigger picture is that interest rates are going up after 40 years of going down, and we're getting a multiple contraction of stocks that were overpriced. And that hasn't played out, in my view, yet. So that is still going to prevail, I believe, and that is the bigger picture trend. The US dollar edged up a little bit, about 0.5%. The yield finished at 1.97. The VIX went to 37, so that's the high 30s now for the second time, and remains elevated at 27.6. Let's look at some charts. Okay, we'll start with the S&P, so you can see, I'll just zero in here so you can see a little more clearly. So you can see the futures, or sorry, the S&P opened up down at 41.55. So this was a serious break of this key 4,300 support. Huge gap, traded down, and then this massive intraday short covering rally kicked in, and it was just an extraordinary finish, and ended up finishing at 42.88. We got follow through on the S&P on Friday, but a lot of that was because of the more defensive part of the market, and you'll see that when we look at some of the spread charts. It wasn't nearly as robust for the growth areas of the market. So that's the bigger picture. Now, if you want to look at this from a bullish perspective, so I've sort of put my bullish hat on here and assume that, well, maybe this selling is over. What would justify this being the bottom? In other words, Thursday night. What would justify that situation? And the points that I could highlight would be that the breakdown, which occurred on Wednesday, wasn't on all that high a volume. So look at the volume. You can see this high green bar. Look at the volume on the breakdown on the Wednesday. Now it was an emphatic candle, but it didn't really have the volume conviction going with it. So that would be point one. The second point is that reversal volumes were on high volume. So this is Thursday's peak here, as you can see. So that's another perhaps tick for the bullish case. The VIX has now been into the high 30s twice. It doesn't tend to do it too often before we've reached the low in the market or the peak in the VIX. So that would be another indicator, but it doesn't preclude the VIX spiking yet again. And if you want to compare this to 2018 and to 2020, it's really quite an interesting scenario. So if we go back to 2018, you can see this period here. We'd sold off, we'd broken support, we sold off for another 3 or 4 days, and then we got a huge rally on the 26th of December. Just forget what triggered that, whether it was some announcement by the Fed, but you can see that this was an extreme turnaround at that point. But that doesn't mean that it'll play out the same way this time, because there's a whole different set of scenarios going on in 2018 compared to 2022. Let's move forward now to what happened in March of 2020. In March of 2020, and you can see we'd been having a sharp sell-off for a lengthy period of time, and then we got this massive reversal, which was a huge gap higher on the 24th of March, that signalled the end of that market, and that also corresponded with a real extreme in the VIX. I think it was somewhere up in even the 70s and the 80s. So there are 4 things that you could argue would validate the bullish case. So I'm not saying that this can't be the bottom. I just don't believe the odds support that. And let's look at some other charts now to validate my position. This is the ARK funds. So Cathy Wood's ARK funds, which have been sold off quite dramatically. And yes, we got a nice turnaround, as the rest of the market did on Thursday. We didn't get very much follow through on Friday. And look at the volumes. There was a bit of a volume spike on Thursday, but Friday was just back to normal. That's not very impressive from my perspective. And there are just so many small and mid-cap stocks in the States that look like that. Also, too, the price has not even yet reached the 20-day moving average, which is heading down very strongly. So all the moving averages have rolled over and are heading down very strongly, and the price is still below the shortest term moving average. So that's not particularly impressive. If we look at the XLK, which is technology, massive turnaround Thursday, some follow through, looks okay on Friday, but again, look at the volume. The volume's not really confirming this. We still haven't made it back to the 200-day moving average, and the shorter term averages have rolled over. If we look at XLY, it's even worse. This is consumer discretionary, so exactly the same thing. Just no real confirming volume on Friday that this is the lows, and we're still not back to any of the moving averages, short or long term. If you look at XRT, which is retail, the absolute foundation of the American economy is the consumer. Same situation. We're still not back to the 20-day moving average yet. And the final one that I would show in this little part is WCLD, which I think I introduced last week or the week before, which is a more accurate representation of the NASDAQ because it partially removes the impact of those really big tech stocks. And you can see just what a strong downtrend we've got down here. We're now 38% off the peak, so this is well and truly into crash territory as far as the bulk of the NASDAQ goes. And again, look at the volume on the turnaround on Thursday, not particularly impressive, and fell back even further on Friday. So when you really look at it, it's it's not as impressive as I would have expected to see. Now let's jump in and have a look at some of the spread charts. Okay, so this is consumer discretionary versus consumer staples. We had a turnaround on Thursday, but look at Friday. Friday actually ticked down again a little bit. So that meant that consumer staples actually did better than consumer discretionary on Friday. That is hardly a vote of resounding confidence that we've seen the lows in the market. This is US small cap growth versus small cap value. Again, the same thing. slight tick down, didn't do all that spectacularly well on a relative basis. So on an absolute basis, the indices look great on Thursday and Friday because all sectors went up. But what you want to see in a market bottom is a move back into growth stocks. And I'm just not seeing it. And there was a slight tick down in favour of value stocks on Friday. Let's look at the larger cap stocks. So the Russell 1000 growth versus value, same thing. We got a one-day kick up, but then turned back down again on Friday. So Friday's rally was not about a continuation of money rotating back into growth. And until that happens, I don't believe we've seen the bottom in the market. And finally, this is the NASDAQ 100 versus the S&P. So the NASDAQ 100 being more aggressive than the S&P. And it's just the same pattern. We are in a medium-term downtrend. We had a blip on Thursday, but no follow-through. In fact, a turn back to value stocks on Friday. So I'm just not convinced that we're at the bottom. And as anyone that's been watching these videos for a long time knows, that my fundamental orientation is bullishness. It's where I spend 98% of my time being bullish on the market for good reason. And so I'm not looking to build a bearish case here. I don't need to do that. I don't need to be right about my short-term bearish view. I'm just calling the signs as I'm seeing them with an open mind. And I'd like to see the end of this this cyclical bear market, if that's what it turns out to be, as soon as anybody else. But you've just got to be realistic that these things do take time. So that is the situation in the US. If we look at the currencies, you can see pretty volatile, particularly on Thursday, spiked massively higher with the huge selling in stocks, but then came back off that a little bit, and then also retreated a bit more on Friday night, I should say. The Australian dollar pretty much reflected that in the inverse and finished at 71.72. So we're still stuck in a range there. Our index was down 3.1% for the week, but I guess we'll probably see a level of buying on Monday, but I don't have any confidence at all about what the Australian index might do. I just think this market is so unpredictable. Events in Ukraine are unfolding pretty quickly, and so there could be a completely different sentiment in the market on Monday to what we finished on Friday. Now, if you look at last week, the resource sectors, particularly energy, helped hold the index up. Otherwise, our index position would have been far worse. And if you look at some of the mega trends, which, and just a point on mega trends, they're going to continue to do really well with a war in Ukraine or not, or more generally in Europe, because the electric vehicle revolution is not going to stop. The cloud computing revolution is not going to stop. Might get slowed down slightly, but those mega trends are going to continue. And where the good returns are long term are in growth stocks. They're not in defensive stocks, because so many defensive stocks are at risk of being outdated, basically, taken over by technology. So battery material stocks, as part of I think an unstoppable mega trend, are still going to continue to do really well. They're going to be volatile in percentage terms, for sure. But the good ones are holding their ground. The percentage fluctuations on a day-to-day basis can be a little bit worrisome. But if you step back and look at a year's chart over a year or 2 years, most of them are really just going sideways in a band. And that's a pretty good effort in this sort of market. So let's take a quick look at the Australian indices. So energy was the best and holding up near its highs. Finance is now down, still below the 200-day moving average, which is almost to the point of rolling over. So financials are struggling a little bit, and certainly got hit on Thursday in particular, and to a degree on Friday. There's healthcare that's been massively hit, particularly around stocks like CSL, which have been trading for decades on very high multiples that are now getting washed out. There's the ASX 200. We're now back down below this support level at 71.65. Been fluctuating up and down, but now we are permanently, well, not permanently, but we are consistently now below the 200-day moving average, which, if this continues for another week or two, the 200-day moving average will roll over in Australia as well. And there's materials. They copped it on Thursday, but generally materials have gone along pretty well. And if we look at small caps, then small caps are also pointing down and at risk of that 200-day moving average as rolling over as well. So certainly there's no real signs of buoyancy in the Australian market. It'd be very interesting to see what Monday does bring. Turning now to precious metals, gold spiked massively, but ended up the week pretty somber, really, I've got to say. And we ended up at 1889. And gold had a brief spike, but just unable to hold it. So I've said it so many times in the last 6 or 12 months, I just don't know what it is that's actually going to get gold going. Given the financial situation that exists in most countries, it's hard to see why gold's not doing better. But it is what it is. Precious metal stocks just really remain a pretty disappointing sector, I've got to say. So let's look at those charts. So we'll start with a quick visit on Bitcoin. So Bitcoin has really suffered, and the people that have been claiming Bitcoin as a alternative to gold, well, when you see gold, it really shot up on the Ukrainian invasion, but Bitcoin is very much a risk-off sort of situation at the moment. This is the gold price on a daily basis. You can see huge spike on Thursday, got up to 1974 at the highs, but dropped nearly 85 points from there to finish the week. If we look at the weekly, you can see it got to the highest level that it had been at since you've really got to go back to around about the peak, which was August of 2020. So a brief spike to that level, but just couldn't hold it at all. And I would have thought that things are escalating in the Ukraine rather than being resolved. So it's really hard to see if an invasion of Ukraine by Russia doesn't get the gold price spiking. Then I just don't know what's going to do it, to be frank. This is silver. We saw a spike in silver. Silver's a bit of a different situation because we've got a supply deficit emerging in silver because of the rise in industrial demand. So, silver perhaps has got a better percentage upside than gold has over the long term, I'm talking. Now, if we look at GDXJ, the stocks traded up quite well on Thursday, but actually finished down on the session. So that was pretty disappointing and really failed to do much on Friday either. So that's the situation with precious metals. Turning to other commodities, copper was roughly steady. Nickel spiked up to 1172, and part of the reason for that is because nickel is a major export out of Russia, and obviously that's probably going to stop. And so that really spiked the nickel price to 1172. Still finished pretty well, but down off those highs at 1132. Crude oil also shot up, got to 96 at one stage on energy fears and finished around 92. Energy security is now an even more massive issue than it was a week or two ago. So that's going to be something that has all sorts of ramifications, because if the oil price goes above 100 and stays up there, then it's contributing to global inflation. That really backs the central banks into a corner, having inflation breaking out at the same time as a war breaking out. What must be one of the central bank nightmares. So lots of uncertainty in the market. And that's another reason that I don't believe that the lows that we saw on Thursday are the end of it, because there's just so many uncertainties that the market can respond to. There's spot copper, not a lot of change. Spot nickel, these are the closing prices, so it's not really reflecting that intraday spike to 1170. But it happened, and there's the inventory position for nickel that's really supporting these high prices. So to wrap things up, this is a time where investors really need to remain calm, and the main reason that I do these Sunday videos is to provide a perspective that perhaps you don't get from the mainstream media that is obliged to sensationalize. I'm just trying to give you the facts so that you can make better choices and better decisions. This is really a time for calm. I think it's a time of great opportunity as long as you've got some strategic cash. If you're still fully invested, then you've got a very, very difficult scenario on your hands. But I just encourage everyone not to give in to your emotions. This is a sort of time when it's easy to do that. I've been through so many of these events since 1987, and you've just got to learn to downplay what the voices in your head are screaming at you to do. The opportunities that are setting up, not necessarily next week, but it could be next month, could be 3 months, might be 6 months, but the opportunity that's setting up can make your year. And this is not terribly dissimilar to what happened at the start of 2020. And 2020 was my best year ever, and that's from the start of the year to the end of the year, so that included the COVID crash. It still ended up being my best year ever because I was able to take advantage. I was able to cash up quickly, got to a comfortable level of cash quickly, and I then had plenty of firepower when the turn came in March of 2020, and I had an exceptionally good year. And I think a similar sort of opportunity, probably not as good because I just don't see the market crashing as it did 40% in 5 weeks. So I don't think the rebound will be as ridiculously powerful as it was in 2020, but the same general principles and setup apply. Now, Portfolio Analyst last week, I think, was a pretty crucial session. I explained why 2020 was my best year. I showed, the decisions that I made for the membership throughout, a number of trades that we took. I talked a lot about managing psychology because that's probably the most important thing you've got to do at the moment. It really is. It's far more important than worrying about, which stocks you're going to buy, although that's still important. We also looked at how the rebound starts, what it looks like, what are the signs to look for. And I got a lot of very positive feedback from members on that. And the final thing is what to do when you feel like just selling everything, just throwing your hands in the air, selling everything and just get out of the way because it just all feels too intense. And there are things that you can do that just make life so much easier. So all that was in Portfolio Analyst last week. Now, the other thing that I'm going to do in the next day or so is to just record a quick video that gives more detail on 2020 and the parallels with where we're at now, which I think are going to be helpful because the most important thing you should be doing at the moment is taking a positive outlook about the opportunity. Now, I can't tell you if we've had the low or when we're going to get the low, but I know what it looks like when we get there. It's pretty starkly obvious when you've been through enough of these. And I can tell you that the opportunity that comes out of the back of this, whenever it finishes, is going to be extremely exciting and extremely attractive because megatrends are not going to be stopped by what's going on. They're going to blast on regardless. So whilst I'm cautious in the short term, I remain extremely confident and extremely excited about what comes beyond that. And I don't have much doubt in my mind that I'm going to be pretty pleased by the end of the year. All right, that's it for this week. There's more information on the website. There's my email address for anyone that wants to contact me directly. And look, I'm sure it's just going to be an extraordinarily eventful week, and I'll review it for you next Sunday. Cheers.